The key aspect about silver is that it has a slight element of industrial demand as well. Long run, we remain exceedingly bullish silver, and at some point it will go up even faster in our take than gold. However, I suggest for people, the most liquid and the easiest storage right now is still gold. At the moment, if we look at the gold-silver ratio, we see a degree of silver relative overperformance, but there's also the possibility that this is going to take longer. We felt that it was coming closer to the point that silver would start overperforming, and then we turned out to be 100% inaccurate on that. It came all the way back, but it took a yen trade unraveling to do that.
Some analysts are predicting that silver might outperform gold due to its relative undervaluation and increased investor interest in precious metals beyond gold. Silver has some industrial demand and is expected to rise long-term, potentially outpacing gold. Although there were signs of silver's overperformance relative to gold, this prediction was premature, and a reversal occurred, partly due to the unraveling of the yen trade. Francis Hunt, known as the market sniper, is a seasoned trader and market analyst, with expertise in technical analysis, analyzes that silver took a hit due to poor economic conditions, partly because of its industrial component, which linked it to the decline in copper prices. The unraveling of the yen trade highlighted this, with industrial demand weakening as retail and consumer spending dropped. The gold-to-silver ratio suggests gold may continue to outperform for a while, as central banks dominate the market. Silver may only outperform once retail investors get heavily involved in precious metals, but this timeline could be longer than initially expected. For now, stacking gold seems to be the safer bet. The government will likely target the middle class because the debt market has shifted since 2020. With high inflation and increasing debt, there's less demand for U.S. debt, even though it's considered risk-free. As the debt supply grows, its value decreases, similar to an oversupply of goods like Crocs, which eventually lose value. Interest rates may see minor cuts, but the overall trend is upward, leading to a potential crash in debt valuations. The Fed, already the largest debt holder, may become the buyer of last resort, especially as the Treasury continues to create massive new debt. This will squeeze borrowers who can't keep up with rising interest payments, leading to significant economic challenges. For more videos like this, subscribe and turn on notifications. Thank you and enjoy the video.
Silver got hammered more. Why? Because economics are looking garbage. So because of the industrial component, copper was spilling. So before this whole yen trade happened, we said the USD JPY is turning down stronger than normal. It's a fear indicator. We highlighted copper. Copper was crashing. Copper was crashing. And then we highlighted yield curve reversion getting very close to that zero line. We said there's something coming. And of course, the industrial, because it's retail and consumer crushed, people aren't buying solar panels for their homes anymore right now. All of those things, copper getting smashed has a slight pull down on silver too, because of that industrial component of it. It's also got the monetary component, but not as much. It's consumed. Silver is consumed as well. And now we say, okay, this is looking more like gold could dominate a while longer. This looks like a continuation pattern. And going up for the gold-silver ratio actually probably means overperformance. So we might get back down to the halfway mark, but we think, okay, this is going to take a little bit longer. It's going to be, who has the money? The central banks do, because they print it up. It's not retail right now. So gold goes faster. When retail starts participating in a major way in the precious metals boom, because of them being smaller and smaller amounts, but much more of them, that's when I start to see silver outperform. But at the moment, that could be pushed out time-wise a little bit further. So we've moved our timeline out for that, and we say keep stacking the gold ounces for now. You're not going to be in the wrong place. Government will come for on the middle classes, the bourgeoisie. And why can't they cut more than go right down to zero? Because the debt market turned in 2020. The debt market turned in 2020, and there isn't the bid under debt markets. So that's why it's been higher for longer. To actually drop rates significantly, back to my seesaw, to drop the rates, my elbow down, the valuation of the debt, my hand, has to go up. Who's going to be storming in to buy debt in America that's supposedly still meant to be considered risk-free when you have incredibly high inflation, massive proliferation in the last event, CB19, you've got a recession on your hands and the consumers aren't buying, the tax receipts are going to drop. Yellen is creating 1 trillion every 100 days of new debt. It now becomes a case where scarcity certainly isn't applying to the debt markets. So how does high value stay there when the supply chain is getting ever bigger and the production is getting faster and more being churned out? And that's where I usually use my pink Crocs example. The first time Crocs came out and you could have a bright color pair, it was almost novel and cute, and check at me, my rubber shoes. But once you have oil tankers, a queue of oil tankers with containers full of pink Crocs, it's no longer a high value item. Everybody who wanted a pair has a pair. They're in every flea market, and they go from $25, $50. You can't give them away for $5. So that's debt. It's proliferation of debt crisis. So actually, the interest rates are going to have a minor pullback. We are in a bull market for the interest rates, in my opinion, which means a crash for the debt valuations. And we're having a pullback period, potentially, if they have the cuts or they just talk about the cuts. How much you'll see, I don't know. But who's going to buy it? In the end, the Fed is already the biggest holder, and they'll have to continue to be. And the Fed we'll go from having toxic banks, commercial banks, that got all the garbage. AIG was a bit like that. They got to be holding the other end of all the bad trades and the subprime debt that Goldman Sachs laid off their risk on, and all the others laid it on, and they sort of propped AIG up. Now the Fed, one level higher, the central bank is going to be the buyer of last resorts in the debt markets at a time that the Treasury is creating $1 trillion every 100 days. So how do you deal with that? Interest rate spikes are going to come at some point. Whilst everyone is talking cuts, you will potentially get 1 or 2. You may even get 3 or 4. But the long-term trend is up. And that means people getting into debt are going to be squeezed out and not be able to make their interest payments.
Francis Hunt predicts that there will be severe crackdowns on unregistered or black gold, with harsher penalties than for violent crimes. Authorities might impose draconian consequences, including hefty fines and prison sentences for owning unregistered assets, similar to the 1933 gold confiscation, but with even more severe repercussions. There could be unannounced inspections of private premises for suspected unregistered gold, and those who speak out against it may be targeted. Despite this dark outlook, gold is still considered the right investment. A trade recommendation was made to go long on gold as the yen trade began to unwind, while also going long on gold and short on oil. This commodity-neutral trade was based on expectations of weakened consumer demand, similar to trends seen before COVID-19. Despite geopolitical tensions like Russia, Ukraine, and Israel, Iran, oil prices are falling, suggesting a significant demand-destroying event is yet to occur. Additionally, the yield curve inversion between the 10-year and 2-year U.S. Treasuries, a key recession indicator, briefly reverted, signaling a potential major economic event on the horizon. Let's get back to the interview.
There will come a point that I've predicted that there will be black gold, unofficial gold not registered, and registered gold, and there will be draconian in the same way as they are emptying violent criminals out of UK jails to put people organizing a protest into a prison to find a seat. In the same way that they are doing that and trying to get social media people put behind bars, they will make a bigger crime and sentence for having unregistered assets than they would or other common criminal by far. And that's how they will disincentivize. By the way, when they did the 1933 confiscation, I think the amount that they could fine you was $10,000 and 2 or 3 years of jail. I stand corrected. Someone in the comments will answer. But that was when $10,000 was huge. It would be the equivalent of, hundreds of thousands today. People had an annual salary of less than that and did just fine. 4,000 or 5,000, you bought houses back then at 1933. So draconian consequences for people that own black assets, with possibility and rights of inspection on premises at a drop of a hat, unannounced, on the basis you might be suspicious of having it. So someone like me talking about this will probably go onto a list and get drop-in visits if I haven't sold the asset by then, for them looking around for dark gold, and we'll be tainted as the worst criminals of all, the people that are stealing from the citizens, because we haven't registered our gold and don't want to pay our fair share of capital gains. So this is what I see coming. And, it's pretty dark, but nonetheless, gold is still the right purchase. You might have to leave country as well. So we gave a trade, long gold, as the yen trade was starting to unwind. We said long gold, and the gold had fallen by 4.7%. We said long gold, short oil. That's a commodity neutral trade. So you could put 100,000 to the upside and sell 100,000 on the dollar oil price and see how you do. And the play idea is the wrecked consumer, not buying, not traveling, business, less meetings, in person, usual stuff we saw just before CV19. This is essentially the CV19 trade. And it's quite ironic that we have an MPOX narrative floating around as well as many other things, because the current oil price has a Russia-Ukraine oil baked in, war baked in, and an Israeli-Iranian acceleration pretty much baked in. It will react if there's a sudden flare-up in any of those, for sure, but people already understand that there's quite a high hostilities and rates, yet it's still falling. And that tells me, man, the demand destroying event is not yet even begun to play. Then you talk about the yield curve reversion that is yet to have fully happened. So the 30s and 2s have reverted back above the zero line. That's usually the triggering event for soon to be named crisis. But the primary yield curve inversion that most people look at is the 10-year treasury and the 2. And during the yen carry trade reverting and unwinding, we got a reversion of the difference. It's just touched positive and then it came back down. So we're already in a standby situation for a major event. It may be worth showing that chart just to sure. Break up the flow here, because this is something people will really appreciate if they can see visually. I'll do that if that's all right with you. So this is the yen, the USD JPY. This correction isn't over until, we start to see a proper rebound in the dollar. But what I was looking to show you is the US 10-year minus the US 2-year yields. So this is the difference you get paid in interest between long-term debt and short-term debt. I know you're familiar with it, but to many others, it will be a little bit like Greek. And the key part about this is there's never a yield curve inversion. That's when you go below the blue line, which is 0%. That doesn't lead to a major recession when it reverts back positively. So I've drawn and put a lot of annotations.
Gold is seen as a safer investment amid economic uncertainty and possible government crackdowns on unregistered assets. Silver has long-term potential but may lag due to its industrial ties. Strategic trades like long gold and short oil reflect caution in a market facing potential economic challenges. What factors contributed to the recent underperformance of silver compared to gold? How might government crackdowns on unregistered gold impact middle-class investors? Share your thoughts on Hunt's insights in the comments below. Don't forget to like this video, subscribe to the channel, and turn on post notifications for more content like this. See you next time.